Are you looking for a way to generate consistent income from your investments? If so, high-yield dividend stocks and ETFs could be worth considering. In this video, we'll dive deep into the world of dividend investing, explaining what high-yield dividends are, who they are suitable for, the pros and cons, and some great examples to get you started. Let's begin. What are high-yield dividend stocks? High-yield dividend stocks are shares of companies that pay out relatively large dividends compared to their share price. The dividend yield, expressed as a percentage, shows how much a company pays out in dividends relative to its stock price. For example, if a stock is trading at $50 per share and pays an annual dividend of $2.50, it would have a dividend yield of 5%. Generally, anything over 3% is considered a high yield. Many high-yield stocks pay out 4 to 6% or even higher yields. These stocks tend to come from more mature, established companies in industries like utilities, energy, real estate, consumer staples, and finance. Companies that generate steady cash flows often pay higher dividends. High-yield dividend ETFs. If you don't want to pick individual high-yield stocks, you can invest in high-yield dividend ETFs instead. These are exchange-traded funds that own baskets of high dividend-paying stocks, providing you with instant diversification. Some popular high-yield dividend ETFs include the Vanguard High Dividend Yield ETF VYM, the SPDR S&P Dividend ETF SDY, and the iShares Select Dividend ETF DVY. These ETFs tend to yield 3 to 4% or higher. Advantages of high-yield dividends. The biggest advantage of investing in high-yield dividend stocks and ETFs is the ability to generate a consistent income stream from your portfolio. This makes them appealing for retirees or those looking for passive income. For instance, someone with a $500,000 portfolio vested in stocks yielding 4% would earn $20,000 per year. In dividend income alone before capital appreciation, high-yield dividend payers also tend to be established companies with solid financials and an ability to sustain payouts over time. Another advantage is that dividend stocks have historically outperformed non-dividend payers over long periods. There's a time-tested investing philosophy that buying and holding quality income stocks can be a path to growing wealth. Disadvantages of high dividend yields. While high-yield dividend stocks offer an attractive income stream, there are some potential downsides to be aware of. Some high-yielding companies are that way due to lagging share performance rather than strong payouts, known as a yield trap. You want to avoid stocks with high yields because their business is in trouble and the dividend may be cut. Many high dividend sectors like energy, rights, utilities, and telecoms can underperform when interest rates are rising, since they are seen as bond alternatives. Dividends also receive unfavorable taxable treatment compared to long-term capital gains. This is a key consideration for taxable accounts. Additionally, some investors argue you are better off reinvesting dividends instead of paying out income if you're still in the accumulation phase before retirement. High-yield dividend stock examples. Here are some individual examples of high-yield dividend stocks to consider across various sectors. Energy. Williams Company's WMB 6.5% yield. Wright, WP, Carey Inc. WPC 5.7% yield. Consumer staples. Altria Group MO 8.1% yield. Utilities. Duke Energy D UK 4.2% yield. Healthcare. Avia BBV 3.9% yield. Finance. Prudential Financial PRU 5.1% yield. Who should buy high-yield dividend stocks and ETFs? High-yield dividend stocks and ETFs can make sense For a few different types of investors, retirees and near retirees, those living off their portfolio and seeking income, can benefit from high dividend yields. Risk-averse investors. More conservative investors can use dividend stocks as a bond alternative to generate yields higher than treasuries or CD. Taxable account investors. It may make sense to favor dividend growth stocks in tax-advantaged accounts like IRA letters and hold high yielders in taxable accounts. Index fund complementers. Investors can complement broad index funds by adding sector-specific high dividend ETFs for more income. Long-term investors. Dividend stocks are appealing for buy and hold investors who can let dividends compound and grow their wealth over decades. Pros should manage concentrated positions. While high-yield dividend stocks and ETFs have a place in many portfolios, it's important not to become overly concentrated in certain sectors or individual positions. Ideally, you want to build a diversified income stream across different types of stocks and sectors. You can complement individual dividend stocks with low-cost, broad-based dividend ETFs. Certain sectors like energy, rights and utilities are more sensitive to interest rates, so maintaining balance is key. You also want to analyze each company's payout ratio, balance sheet, and dividend sustainability. Portfolio allocation to high-yield dividend holdings will depend on your time horizon, risk tolerance, and desired income levels. It's often recommended to cap any individual position at less than 5% of your portfolio. The bottom line: high-yield dividend stocks and ETFs can be an excellent way for investors to generate consistent income, develop diversified income streams, and benefit from the long-term compounding of dividends. However, it's critical to analyze the fundamentals of dividend payers, be wary of potential yield traps, and maintain diversification in your income portfolio. If used prudently as part of a balanced strategy, these higher-yielding income investments can help provide cash flows for investors of all ages and risk tolerances. I hope you found value in this overview of high-yield dividend investing. Let me know if you have any other questions.